Most people don't realize this, but one small crypto tax mistake can cost you thousands of dollars, trigger an IRS audit, or even lead to penalties you didn't know existed. And the worst part? The IRS already knows more about your crypto than you think. So if you've bought, sold, traded, staked, or even just received crypto in the US, this video could literally save you thousands of dollars. Today, I'm breaking down crypto taxes in the United States in plain English. You'll learn what's taxable, what's not, the biggest IRS mistakes people make, and most importantly, legal strategies to reduce or even eliminate your crypto tax bill. Let's start with the most important thing you need to understand. In the US, crypto is treated as property, not currency. That one rule changes everything. Every time you sell crypto, trade it for another coin, or use it to buy something, the IRS sees that as a taxable event. Here's a simple example. Let's say you bought Bitcoin at $20,000 and later sold it at $30,000. That $10,000 difference is a capital gain, and yes, it's taxable. Even worse, if you didn't sell it for dollars but traded it for Ethereum, the IRS still considers that a sale. No cash involved, still taxable. Now let's talk about short-term versus long-term capital gains, because this alone can save you a lot of money. If you hold crypto for less than 1 year, your profit is taxed as ordinary income, meaning it could be taxed anywhere from 10% to 37%, depending on your bracket. But if you hold crypto for more than 1 year, you qualify for long-term capital gains, which are taxed at 0%, 15%, or 20%. For many people, simply holding a few extra months can cut their tax bill in half. Now here's where most people mess up. Crypto income is not just buying and selling. If you earned crypto from staking, mining, airdrops, referral bonuses, play-to-earn games, or getting paid in crypto, that income is taxable the moment you receive it, based on its fair market value in US dollars. So if you received $5,000 worth of staking rewards, that's $5,000 of taxable income, even if you never sold it. And when you eventually do sell that crypto later, you could be taxed again on any price increase. That's 2 layers of tax most people don't plan for. Now let's talk about the biggest myth I hear all the time. No one will know about my crypto. That is dangerously wrong. Crypto exchanges like Coinbase, Kraken, Gemini, and others report to the IRS using Form 1099. The IRS also works with blockchain analytics companies that track wallets, transactions, and exchange movements. If your return doesn't match what they already have on file, that's when audits, penalties, and letters start showing up. So how do you legally reduce your crypto taxes? Here are real strategies smart investors use. First, tax loss harvesting. If you have crypto that's down in value, selling it at a loss can offset your gains. If you made $20,000 in gains but have $10,000 in losses, you're only taxed on $10,000. And unlike stocks, crypto currently isn't subject to wash sale rules in the same way, though that could change, so timing matters. Second, track everything accurately. Cost basis errors are one of the most common reasons people overpay. Using proper crypto tax software or a CPA who understands crypto can literally save you thousands. Third, hold for the long term when possible. That 1-year mark is one of the most powerful tax tools you have. Fourth, use deductions strategically. If you mine crypto as a business, you may be able to deduct equipment, electricity, and other expenses. If you trade actively, structuring your activity properly can change how it's taxed. And finally, don't ignore state taxes. States like California and New York will tax crypto income on top of federal taxes. Planning ahead matters. Before we wrap up, here's the biggest mistake I want you to avoid. Do not skip reporting just because you didn't get a form. The IRS question now directly asks if you've had any digital asset activity. Answering that incorrectly can create bigger problems than paying the tax itself. Here's the bottom line. Crypto taxes aren't about finding loopholes, they're about knowing the rules and using them legally to your advantage. With the right strategy, you can avoid penalties, reduce your tax bill, and sleep a lot better at night. If this video helped you, hit the like button. It tells the algorithm this content matters. Subscribe if you want more straight-to-the-point money, tax, and wealth strategies made simple. And if you're serious about crypto and taxes, talk to a qualified tax professional before making big moves. Thanks for watching, and I'll see you in the next video.